Hey everybody, welcome to Karina Lanta Mentorship here with another brainwashing session of becoming debt free. And I honestly think that the people who watch this channel want to be brainwashed because I do say the same thing over and over again, and people keep watching. Watch time is relatively high, even though the view count is not so high. And here's what I'm going to brainwash you all today is that banks don't lend money to people who need it. I think I've said this a million times. Banks don't lend money to people who need it. Banks don't lend money to people who need it. And a lot of people get shocked when they hear this because they think the bank is there to help them when they have cash flow issues or stuff like that. And that kind of is true, but only when you get the money when you don't need it. Okay? All right, well, that's that's the brainwashing verse of the day. So let's go ahead and get started. And we're just going to do the same scenarios last time. And if you kind of take a look at the results here, it was 9 years, and we were paid off $647,000 of debt, over $500,000, and just acting casually like it's no big deal, right? Well, we just paid off $500,000, no big deal. All right, so let's go ahead and get started and redo this again. So we're using something called the velocity method to pay off debt. So what is this method? Well, if you deconstruct it, right, deconstruct brainwashing, all it is basically not saving money rebranded. I don't know if you need that. So you see the checking and savings here. It's like not saving money 2.0. And you might be like, yeah, that's it. And I'm like, yeah, that's totally it. And a lot of people they get the results when they try it themselves. Now, I don't make any guarantees, but that's what people write in the comments. So this is what we're going to do is we're going to create a budget, and then you could see from our average American style of budgeting that we have our income, our expenses, and then our leftover checking and savings, and you see that 96 cents is left over here. And so the question is, with all this debt, 5 credit cards, 2 auto loans, a student loan, a mortgage, and what was the last part? A partridge in a pear tree? Never mind. I don't know. I never get the last part right, but it's the how many days of Christmas that my true love came to me? Yeah, okay, 5 golden rings. So what I'm talking about, I don't even know. All right, so income expenses left, you have less than $1 left over. And so when you take a look at this here, you ask the average person, hey, like, you have this much income and you have all this debt and you have 96 cents left over, do you need more money to get out of the hole? And everybody will say yes, right? So what we do is show with this method, same income, same expenses, but deliberately not saving money and then using something line of credit can make this number increase exponentially. Okay? And so what we're going to do is focus on this cash flow number. Now, according to the average American banking style, checking and savings and cash flow are exactly the same, right? Because you pay your bills, and then after you pay your bills, whatever's left over goes in checking and savings. That's the responsible thing to do. Yet at the same time, when you have debt, right? How are you supposed to pay it off if you're not actively putting your income towards debt? And that's what we are going to do. So, in order for us to do that, we're not going to save any money, right? And then what we're going to do is use something called a line of credit. So, what's a line of credit? Think of a credit card, that's a line of credit. There's actually products out there called personal lines of credit, business lines of credit, home equity lines of credit. Basically, a financial tool where you could borrow money, pay it back, and then use it over and over again. Okay. And so what we're going to do is use this as quote our main operating account. See the difference between this method and this method is that with this method, the average American banking method, the final destination of money is your checking and savings account, right? Whereas with the velocity method, the final destination of your money is something called the line of credit, and your checking account is just a temporary place where your money is stored. It's not the final destination, right? That's really the difference in mindset. And then what we're going to do is we're going to move some debt into our line of credit and then dump all of our entire paycheck into the line of credit. So what we're going to do is rank our debts using something called the cash flow index. And if you don't know what the cash flow index is, it's just a formula of the debt balance divided by the payment. And then you do that for all of your debts. And then what you do is you just rank them. So I just happen to rank them from smallest to largest, and the reason why we do that is that if you have a very small number, that just means that that's the debt you want to pay off first, because you get a lot bang for your buck for paying off those low number debts, right? So if you take a look here, 30-year mortgage, in order for me to pay off the mortgage, I have to give someone $320,000 to get $1,500 back in my cash flow, right? Whereas if I pay this debt and this debt, I think it's 57,000, I get $1,800 back in my cash flow. So that's more cash flow for paying this off than the mortgage, okay? And so that's what we're going to do, and we're going to move the debt, and we're going to pay off the credit cards first. And let's see how much credit card debt we have. And I'm going to go ahead and sum it up. So that's $85,000. $85,000, okay? So let's move the $85,000 of credit card debt into the line of credit. Remember this, we're not getting rid of the debt. We're just balance transferring it, right? And when we balance transfer it, guess what happens here? Oh my goodness, these all turn to zero, don't they, buddies? These buddies turn to zero. Okay, and then guess what happens? 96 cents somehow turns into over $2,000. Whoa. Okay. How did that happen? So it's almost $3,000, 2,800. How did that happen? Okay. Well, the way that it happened is through sorcery and brainwashing, right? How do I know this? Is because I brainwashed myself to figure out how to go from 96 cents to $2,828.48. And how do we brainwash ourselves? Banks don't lend money to people who need it. That's the phrase we got to say every single day in order to maximize our cash flow and not fall into the trap of the banks, right? Now, realistically, this is the serious part, is that a lot of people don't understand how to get credit, okay? And they'll see something like this, and then they'll try, they'll have like 96 cents left over, and then they'll try to go to a bank. How do I get a $100,000 home equity line of credit? The answer to that is if you have 96 cents left over because you have too much debt, the bank's going to look at you and laugh, and they'll be like, "Yeah, right, right." And the reason is that banks don't lend money to people who need it. Banks don't lend money to people who need it because people who need money don't pay you back, right? And if the bank wants to survive, let's say the next quarter, and they lend to too many people who need money, they're going to become broke. And you know what? The bank staff themselves are not immune to this. There was like a Midwest bank that where the CEO actually fell for like a crypto butchering scheme, and then he lost like 40 million. Actually, let me go ahead and look for that. So Midwest Bank CEO pig butchering, and I think he went to jail for at least like 10 years or something. Yeah, this guy, 24 years. Heartland Tri-State Bank, Shan Haynes, basically he was the CEO of the bank. And then he basically sent $47.1 million to a current cryptocurrency scam. That is crazy. That is crazy. And I think that was on the FBI website too, and the Department of Justice. So, even the bank staff is not immune to bad schemes. But if the bank wants to survive, which this one didn't, unfortunately, they have to not lend money to people who need it. Because lending money to people who need it means that they're not going to survive, right? So it's literally for their survival. Now I know what you're thinking is, well, I need the money, right? And so what you have to do is do things in the right order of operations, and so that you get the line of credit before you need the money. And why do we demonstrate all of this with the free and clear line of credit? Is because it makes the concept so much more easier to demonstrate than doing a realistic case scenario. Last time I did a realistic case scenario was 22 debts, $4 left over, and it took me like almost an hour and 15 minutes to kind of figure it out. And that live stream is in a 99-cent paywall, so if you want to see it, it's YouTube channel membership, 99 cents. So yeah, so I'm not gonna stay here for an hour just to do that, but if I stay here 20 minutes, I'm good. So now the final step is we put the entire paycheck into the line, take our expenses out, and then rinse and repeat over and over again. Okay, so I'm gonna go ahead and do this. Previous month's balance minus previous month's interest is how you get the next month's balance, plus the cash flow, or minus the cash flow, I'm sorry, minus 46. And then what we're gonna do is take the average daily balance, that's how we get the interest, multiply it by the interest rate, divide by 12. Okay, so I'm going to go ahead and copy and paste, and then let's go ahead and do that and see that the debt goes down, and in month 34, our credit card debt is completely gone. Woohoo! All right, so it's a lot of brainwashing that's going on today, but I love it, especially when we're debt free. So 34 months, and then we have 85K paid off. So let's go ahead and do that. And I'm going to do this, and okay, and then we have the auto loan, the student loan, and the mortgage, and then we see in 34 months what's the deal. And luckily we got this loan calculator to tell us what the current balances of all the loans are if we type in the current month, which is 34. And then we have the cash flow indexes, and then we just follow the cash flow index formula, right? I would rather pay this 18 grand for about, I don't know, $850 of cash flow rather than 156 grand for 2,322, right? Makes sense because you get more bang for your buck, the ratio of debt to payment. Okay, that's what the low numbers mean. So let's go ahead. I'm going to go ahead and copy and paste, and I'm going to do this, and then I'm going to sum it up, and then now, so the two auto loans sum up to about 19 grand. So we just move that into a line of credit. Let's go ahead and do that. So that's going to be plus 19097.89. And then this is what we're going to do. This is going to be 0, 0. And then now our cash flows are $3,592.10. Okay. So now let's go ahead and do that. I'm going to go ahead and copy and paste. This is going to be minus 3592.1. And then now this 40 months. Okay, so 40 months, it's all gone. And so now we just put in a milestone that in 40 months we paid 2 cars. So that would be 40 months. And then it'd be 85 plus 22 plus 20. And then it'd be 127K. Okay. All right, so now we have the student loan and the mortgage. And then let's just do this. So this is going to be 0, 0. And then this is going to be 40, 40. And then that's going to be 148 grand. So again, follow the cash flow index again. So at this point, what we're going to do is we only have a $100,000 line, and this is a $148,000 loan. Now, does this mean that we should try to move the entire loan into a line? The answer to that is probably not. Now, if the interest rate, I would say just as a rule of thumb, is same or higher, you can safely move it into a line. It's not going to be a big deal. The biggest deal is when you have a low interest rate loan and the term of the loan is very long, right? So like a 30-year mortgage. So if you have a very high cash flow index, what does that mean? Well, if you move this $300,000 4% loan into, let's say, an 8% line of credit, you only get itty bitty amount of cash flow. So you're probably going to end up, well, I won't say probably, I've done this a billion times. You are going to end up paying a heck of a lot more interest than you have to, right? In fact, there's a way, which I'll show you, where you can use even a 30% credit card and you'll still win over 8% first lien HELOC. That's what they call it when you replace a loan with the line of credit. Okay. All right, so let's go ahead and do this. And 7%, 148,000, $2,322.17. So what we're going to do is we used to call it chunking, but I've decided, you know what? I'll use another name. I'll call it the sweep. We're going to sweep parts of the loan into the line of credit, right? So we have this $148,000, okay? And then let's just sweep, we'll say $10,000 from the loan to the line, okay? Loan to the line. And you might be thinking, does this really work? At a very high level, you see that the 10,000 is gone, right? So, let's see. Yeah, the 10,000 is gone, and then we just do it over and over and over again, right? Hold on. Did I update the cash flow correctly? No, I didn't even do that. My bad. Okay. And then you see that every couple of months or so, that 10,000 just gets wiped out over and over again. So you might say, what's the difference between doing this and doing extra payments? And I will say that extra payments is the default that nobody does. And the reason that nobody does it is because it requires too much brain power and will eventually lead to decision fatigue, right? So there's this little chart that I created here with the difference between extra payments and this method is, right? And a lot of times people say, well, extra payments is superior. And I say, okay, then why don't people do it? Right? So this is something that I'll say, like, if you try it, you realize it's much easier on your life because the mindset becomes that your checking account must go to zero and your HELOC must go to zero. So there's no real thinking involved, if you know what I mean. Like when I did this, especially I did this first time with like a Discover credit card for $5,000. It's like I'm gonna do a little chunk or sweep of $5,000 into my mortgage, and then like I paid it off. I was like, whoa, like this is so cool. Like I can't believe that it worked, right? Because a lot of times you're afraid of using like a 20% interest card on, let's say, a 3% mortgage, and my mortgage was 3%. Okay, so let me just kind of show you here about the let me see right here, the estimated payoff. All we got to do is just put in the numbers here in this band calculator that I cannot call it by its name, kind of like Voldemort. But let me just kind of do this. So what's our income? This is our income. Our expenses is everything except for the loan we're trying to pay off, right? So the loan we're trying to pay off is, or I'm sorry, everything except for the loan we're trying to pay off. So it'll be 3527.73. So let me just do that right here. So 3527.73. And then what's our current balance? So our current balance is 200,000, or I'm sorry, that's the original balance, 200,000. And then the current balance is right here, so 148,112. Okay. And then it's 7%, 10 years. And then what is the payment? 2322.17. 2322.17. Bam! 2.3 years paid off. Okay, so now we just do the same thing. So now this is 0. And then now this becomes 0. And then this is going to be 40 plus 2.3. So that's going to be 68 months. Okay, 68 months, 327K. All right. And then now we have the 30-year mortgage. So now we just do the same thing with the month 68, right? And then we just put in the details and tell us how much we will have to pay. Actually, let me just do this. Yeah, see that? Because this is what I originally did in the beginning, because I did the same exact presentation as last time, and it gets paid off in 3.5 years. How about that? If you had a mortgage and you paid it off in the 3.5 years, wouldn't that be awesome? Because I paid my off in 2 years and 9 months, and when I told other people, I don't think they believed me, or I don't know if they didn't care or something. It was like they was talking to a ghost. That's what it felt like. I think that's why I was kind of going a little bit nuts for a while because I was just like, wow, I did it in 2 years and 9 months, and I don't think anybody cared. Okay. Anyways, but that's because they're probably struggling, and so they don't have the energy to care, and I know what that's like too, right? Okay, so that's 3.5 years. So let's just go ahead and mark that down. 0, 68 divided by 12 plus 3.5. 9.17 years debt free, and then so that's 327. So that's 647K. I believe it's 647K. Is it? No, it's not. Wait, hold on. This one should be 85. Oh, I'm just getting confused. Yeah, 647K, I think. If I'm off 10 or 20K, who cares? Okay, well, that's it for today, folks. This is Korean Latin Mentorship with another brainwashing session. If you've enjoyed this brainwashing session, just type in the comments below. Banks don't lend money to people who need it, right? Banks don't lend money to people who need it. So that's how I know you've been brainwashed. Put in the comments below. Let me know. I am your possible cult leader. This is Korean Latin Mentorship.